Markets have been applauding banking stocks for a while now, but is there now time to get cautious, or it is time now to change the view from optimistic to cautiously optimistic? Vinay Sharma joins us, fund manager with Nippon India Mutual Fund. He understands the banking sector. He's got a very deep understanding of cycles and what is in store for the sector per se. Vinay, good morning. Thank you for joining us.
Good morning, Egan. Thanks for having me here.
When we walked into the show this morning, there's a comment from Uday Kotak, which is that the NIMs for banks have peaked out. Then we had one of your peers from Alchemy, he also seems to be endorsing the same. Do you think this exceptionally strong, high margin, high growth for banks now is over?
So we would say, Nikunj, that at some point of time, this would always happen, right? The base effect would kick in, and the pace of margin expansion was not sustainable because it hurts other industry segments if banking margins remain so high. Plus, deposit growth is lacking credit growth for quite some time, and loan repricing happens faster than deposit repricing, as we all know. So therefore, all these cyclical things put together, banking margins now I think would find a base. But the bigger question to our mind is whether banking earnings will disappoint anytime soon, or is the asset quality reversing at any point of time? Do we need to get cautious on the credit cycle or credit growth? To us, the answer is still a no. We still believe we are in a good shape when it comes to credit cycle, and there are no big asset quality issues that we can imagine at this point of time in any of the large segments, whether it's household, whether it's corporate, whether it's SME, MSME. So while it is true that margins have sort of peaked, and maybe in a quarter or two you would see you expect some sort of decline in banking margins, but we still continue to believe that banking earnings will be a strong driver of Indian corporate profits in FY24 and FY25. And unless global growth surprises us really negatively, this view sustains.
Vinay, morning. Is there a worry that, yes, we may see strong earnings momentum sustain in the final quarter of the fiscal year, but once we see interest rates starting to rise, that could be a major drag on credit growth for some of these banks?
So again, the answer remains the same. As I said, that there would be some base effect that would play out, and credit growth would probably cool down from the high teens to maybe mid teens. But we still expect banking earnings and credit growth to sort of in these mid-teen sort of range for another 1 or 2 years. As I said, we still believe that there are several legs to credit growth. Retail has been doing well for some time. Corporate credit growth has picked up. We are seeing short signs of private capex picking up, and manufacturing is sort of here to stay for some time to come. So all these put together, we believe mid-teens credit growth is possible for the next at least 1 or 2 years, and earnings growth would probably be in line with the balance sheet expansion now, because we have seen the best of margins as well as the credit cost decline that banking system has seen over the last few years.
Is the best for PSBs though, Vinay, behind us?
Sorry, I didn't get your question.
PSU Banks is the best behind us now, and I'm not talking about SBI. I'm talking about the smaller ones.
Again, we have always been selective on PSU banks, and we have preferred large banks over the mid-sized banks. But on an aggregate basis, if you look at PSU banking space, we believe it's in good shape for some time to come, because one, the deposit franchise of PSU banks still is very strong, and given the scenario that we are talking about, where deposit franchise actually plays a very important role in determining margins and earnings of banking sector over the next few quarters, we believe this deposit strength will play out over the next few quarters. And therefore, PSU banks are in a decent shape, given that we are still sanguine about credit quality and we do not expect credit quality to show any signs of stress. PSU banks generally tend to sort of underperform, or be relatively underperform when the credit quality starts turning around. That is not a view that we have at this point of time.
Um, When we are looking at slowdown which has kicked in post-festival season, small ticket categories, rural demand is still anemic. But if I look at the retail growth is absolutely gangbusters. So one side we are looking at slowdown, second side we are looking at the retail growth. It's not adding up.
That is correct, Nikunj. I think we have seen this K-shaped recovery that we keep talking about, where the middle class, upper middle class, and the high income segment of India keeps doing well, whereas the bottom of the pyramid has not really come back to its normal strength as of now. We believe some of these again should start normalizing, especially with this election spending and all those talks that you were doing with your previous person on the channel. Some of these would normalize, but yeah, that is the reality that India is going through a sort of K-shaped recovery where the upper middle class and the high income segment is doing quite well, whereas the rural incomes have not revived to their full extent.
Okay. Uh, so one looks at the assumption that 15 to 18% credit growth is here to stay. Would you say that that is something we should also expect from the stocks also? It's not going to be a P re-rating or a price to book re-rating. It's going to be simple earnings growth, whether it is 10, 12 or 13, depends on the growth.
I would say, given the recent correction and the FII outflows that we have seen over past few months, some of private banking names and some of the large PSU banks have again become reasonable in valuations, and there is scope for some re-rating as and when this belief comes back that we are in the middle of a benign credit cycle and there are no credit issues at this point of time, and earnings will remain strong. So we believe that there is some potential of re-rating possible in banking sector. And if you look at 10-year averages or 5-year averages, 5 year has been is sorry a bad period because India went through that NPL crisis. But if you look at 10-year averages and generally the ROA potential of these banks and the fundamentals in terms of growth and returns, we believe there is some scope of re-rating. So I would say before this correction, what you said would be exactly what I would echo as my opinion as well. But given the correction that we have seen over past few months, valuations have become reasonable again.
Okay. Let's wrap it up with one final question, and that's a completely macro question. What if inflation remains high? And what if after a 25 bips rate hike, we may end up with another 50 bips rate hike? What happens to banks in that kind of a scenario when the macro, which everybody's assuming would be inflation will peak out and interest rates will peak out, if that thesis, let's say, gets challenged in next 3 months or 6 months?
So yeah, if we are talking about risk, I think there are two big risks to both Indian macroeconomy as well as banking sector, because banking sector finally is a reflection of macroeconomy in a larger sense. So we think the two bigger risks to markets, banking sector, economy, all of that. One is a global slowdown, and that's the primary one. If global slowdown is far deeper than what we expect at this point of time, if US really had to put brakes on his has to put brakes on growth and go through a slowdown phase for more than 2 3 quarters, that would be detrimental to our growth, some of the export related sectors and general flows, capital flows, all of that, and obviously that would be detrimental to market valuations and banking sector valuation. The other is what you said: if inflation remains high even in India, and we have to raise interest rates to that extent where it starts hurting corporate loan growth or housing loan growth or general economy, like if liquidity is tight and all of that. If that scenario happens, obviously we'll have to revisit our assumptions. But as of now, the assumptions that we have taken is global slowdown would be benign and it would not be very harsh. And second, Indian rate cycle peaks out somewhere when US interest rate cycle peaks out, it's somewhere around that time Indian interest rate cycle and Indian inflation also peaks out. So these are the broad assumptions behind what we have been talking about, that global slowdown would be benign and inflation would come under control. But if that doesn't happen, yeah, then there could be risks to macroeconomy as well as market valuations.
Okay, Vinay, great to have you on the show. Thank you so much for taking the time out and joining in today. Let's just revisit the market. We're completely flat. Ambuja Cement holding up 3%. NMDC looking good by another 3%. IGL, Lalpat Labs, Emphasis, these are all big winners in trade. Of course, the positive news flow on Ambuja and ACC both is that they've got to resume their operations in Himachal plants, and the freight rates have been lowered now by 10 to 12%, and this augurs very well for both.